Morning, Market Chameleons and King Chameleon Dmitry Pargamonik. You ready for part dose today, Dima?
Good morning. Well, yep. We'll continue on the option.
Awesome. Let's start with the disclaimer.
Yep. Good morning, everyone. Thank you for joining. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
Excellent.
And I think what we'll do today, I'm going to share my screen real quick. We'll continue on top of yesterday's discussion, looking at option block trades. And we're going to go over one of our screeners, look at each data element, and talk about why it's important, what it tells you. So I'm going to continue on that today. But before we get to that screener, as usually, I'm just going to take a quick peek on what's going on in the pre-market hours. These are stocks trading in a pre-market. And this is the report. So we have the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm going to peek down here just to see how many made the percentage gainers list. We got 105 versus the decliners list, 37. From that perspective, it looks like a more bullish bias towards the open. Let's just take a quick look at what's going on in the higher market cap stocks. So I'm going to use this filter, market cap of $20 billion or higher. Again, I see 22 made the percentage gainers list, 8 on the percentage decliners list. So still, more, it looks like more bullish bias at the open in the higher market cap stocks. I'm just scanning it really quickly with my eyes. Nothing jumps out at me, very unusual, not a lot of volume trading in any of these stocks, maybe just like Ford up 2% in the pre-market hours. So just to save time, we're on part 2 on options block trades. I'm going to move on unless you have any questions specifically on the pre-market. Will.
Sounds good.
All right. So let's jump back to the option block trade screener. I'm going to come here. And just a quick recap. These are option trades that are typically what we have right now filtered as 200 contracts or more that trade in one trade. I think you can use this filter to go down, over 50, but I'm going to keep it at 200. And a lot of traders come to the option block trade screener to find potential trade opportunities. And we talked about it's never a good idea just to piggyback, even if you see a very large trade, even with, a lot of notional value behind it, because you don't know the intent of the trade. And you always want to go and do your due diligence and see what is the catalyst behind the trade and if you agree with it, because if it's a bullish trade or a bearish trade or a volatility trade, where volatility is low or volatility is high, you still need to do an analysis to see that you agree with this trade and why you're really getting into it. But a lot of traders, that's where their starting point is, looking for something unusual, a block trade to start their research. Okay. So again, we went through, took a look at it. There's almost 80,000 trades yesterday that made the option block trade screener. And of course, you'd never want to piggyback. That would be, they don't all work out just because it's a big trade. Okay. We went over how some of these data elements are important. So yesterday we went over the option details, the initial trade details, and the volatility. So that's in yesterday's video. If you want to go back, you could take a look at it. If there are questions today, I'll be happy to answer the questions from yesterday. In the meantime, I'm going to keep kind of moving on and looking at these other data elements. So I'm going to scroll over here, and here we have trade analytics. So these are kind of and a little bit more details following the trade, right? So we know what the trade was, the amount, the price, and so forth. What other details can help us out? to gain more insights. So one is the exchange, and we have a lot of different exchanges. Some exchanges we talked about have a hybrid system. It's electronic, and they have a floor and a floor-based operation where somebody could still have a broker, call a different broker on the floor, try to negotiate a trade with market makers and specialists. And if they're looking for more liquidity or trying to put up a complex trade or trying to negotiate for a better price, there's still floor operations. I think the PHLX owned by NASDAQ has one. I think the CBOE has a floor presence. So, the New York Stock Exchange that has the American Stock Exchange, I think they still have a floor presence where brokers still can negotiate with somebody on the floor. And so you could look at, if that happens, you're going to see a trade indication that it occurred on the floor. So I'm just going to scan down here with my eyes, and I see here floor trade. So this looks like this particular trade traded on the Philadelphia Stock Exchange. It had a stock contingency, so there's a stock tied to the option trade, which could have been a delta neutral trade or 1-for-1 with the option. And this occurred on the floor. In other words, it wasn't electronic. It was done, physically on the floor where a broker represented the trade and traded with the market makers and specialists. Okay, so these are the exchanges over here, and I'll show you another way you could use them to tie multiple trades together. This is the condition of the trade. So these are reported along with the trade on the trade tape. So we got different type of trade conditions, and I'm going to scroll down here, and a lot of them are here in explanation. So there's a regular trade. You can see this is a transaction. Regular sale didn't have any specific condition, like it didn't say that it was part of a stock contingency, part of a spread or straddle or anything like that. It was just a regular, buy or sell option trade. Auto execution, very similar to a regular trade, except that it got executed electronically right away. Sometimes they don't get executed right away electronically. They could get routed away to a better market. They could get posted really quickly, and then a limit order and then get hit. So if it's auto executed, it'll get an auto execution tag. Regular trade, go to regular trade. Intermarket sweep. This is a different type of order, and the way an intermarket sweep works is when somebody wants an immediate execution and they're afraid that the market might run away from them, they could put in an intermarket sweep. And what an intermarket sweep does is it bypasses this Reg NMS rule. So Reg NMS rule says that if you send an order to one exchange, and if there's a better price on a different exchange, okay, that exchange has to route your order to the other exchange first to see if it could get executed. If it doesn't, then it gets routed back. So there's this Reg NMS rule where the exchanges are all linked, and they cannot execute your trade if there's a better price available on a different exchange. Okay, that's Reg NMS. So an intermarket sweep says, look, while this is being done, while my order, if it goes to the CBO and then the CBO says, wait, there's a different price on the PHLX, I'm going to route it to the PHLX, and wait, the market moved. Now there's a different price on the Amex that's better. It routes it to the Amex. That market moved, then it goes back to the CBO. So while it's doing that, if the market is running, you might not get your fill actually, right? Because your order's being routed through the system, trying to get you the best price somewhere else. So an intermarket sweep said, I don't care if I trade through a market, that's better away. I just want to get my execution filled immediately on the top of the book on each of the exchanges. So split my order and go to all 4 exchanges. You get a limit order, maybe a market order, and you want to sweep the top of the book. So the best, let's say you're buying it, you want to take the best offer, SIBO, Amex, Philex, whatever it is, you go immediately to all of them, which says that I may be trading through a market, but I don't care because I don't want to risk the stock and the market running away while this is happening. Does that make sense to everybody? Hopefully. So that's an aggressive order where you just want an immediate execution and you don't care about this, Reg NMS routing rules, because while that's happening, you may lose out. You may not get executed at all. Okay, so that's an intermarket sweep order. So sometimes what you'll see is an intermarket sweep order actually trade through the NBBO. Okay, in other words, there might be a better offer somewhere, and you'll see the trade actually trade higher than the offer, than the NBBO offer, because you're taking top of the book. Stock contingent, we just talked about that. That's a transaction that says I want to execute only this trade along with the stock. So you have two legs to the trade. Maybe you're doing a buy right, or you want to do a option which is delta neutral. So maybe you're saying here's a 50 delta option, but I don't want to risk doing the option and then getting my hedge off, because the stock can move. So I want to do them both at the same time. That's a stock contingent order. So the other side gives you a quote on both, and then they put that up. So that's stock contingent. Multi-leg transactions. There are lots of different ways to create multi-legs. You could have a spread, which is buying one option, selling another option. You could have a straddle, buying two options at the same time, selling two options at the same time. You could have different ratios, a spread could even be in different expirations, like a time spread. So multi-leg said that I need all the legs executed at a certain price, right? So that's what a multi-leg is. So it's one transaction, including all the legs of the spread at a certain price. So you're not doing one leg at a time yourself. Okay, so that's a multi-leg trade, and then multi-leg proprietary product. That's if it's in a proprietary product like SIBO's, VIX, or SPX, and so forth. So let's take a look at a couple of them here. So these are here auto executions. We talked about that gets filled immediately, and here we have a multi-leg. So the way the multi-leg works is they don't give us the details of, like, this is all part of one transaction. So the trade tape doesn't do it that way, just reports each leg, the price of each leg, but it tells us that each of them is part of a multi-leg. So here, if I look at this trade here, in SPY, May 26 put, traded 250 options for $1.59. And I go over here and I see, okay, this traded on the Emerald Exchange, and it's a multi-leg trade, meaning there's another part to this trade, right? This is just one part of the trade, this one option. And I see it's been executed on a complex order book. The complex order book, that's where you actually don't see quotes. It's kind of hidden because, the complex order book takes these multi-legs and creates a quote or a limit order. And because the quotes, when you look at an options chain, you only see each option. You're not going to see the complex order book. You could subscribe to the complex order book, but it's not something that's published on the tape until it gets executed. All right, so we know that this was done on their complex order book. So we have to figure out, well, what is the other part of this trade, right? So we know this option is a multi-leg traded on the Emerald Exchange, and it happened at 4:13:15 p.m. So the next thing we want to do is say, okay, around that time, 4:13:15 p.m. So I see it over here in the same stock. We see SPY. We see here actually on the same on the sorry on the put, same expiration on the put, that's one strike lower. We see again same exchange, Emerald. So the multi-leg has to be on the same exchange, Emerald. It's also multi-leg on the complex order book. So this is how we kind of match up that these two are most likely part of the same trade, right? This is one trade, and these are the two legs of the trade. So we take the data and we match it up, the time, the exchange, the condition, and then we could see here, okay, looks like the 419 put traded at $1.59. The 418 put traded at $1.11. So it looks to me like most likely a spread that was traded for 48 cents. Okay. It may not be, it could be buying both and selling both as well. They don't tell us that. You know, they changed the conditions. Before they used to tell you if it was a spread or a straddle. Now they just say it's multi-leg. So it could be buying both, it could be selling both, or it could be buying one and selling one. That is left up to interpretation. To me, it just looks like it's probably a dollar put spread that traded for 48 cents. Okay. That's the multi-leg. Intermarket sweep, here we have it over here. We see that this looks to me like an IWM, 200 contracts traded for 440, probably all on one exchange on the bats, and he got filled. So that's an intermarket sweep order. Let me see, stock contingent we talked about. So I think we talked about most of these conditions. The way the execution occurred is, if we just talked about complex order book, because the complex order book kind of sits there in the background. It's not actually whatever is sitting there, limit orders. You're not going to see them unless you subscribe to the specific exchange's complex order book. All right, but that doesn't go on the consolidated tape. Floor trade, we talked about, that's didn't happen electronically. That happened on a physical exchange. The delta of the option, that's just letting us know at the time of the trade, what was the delta of that option. So a put has a negative delta, a call has a positive delta. What does the delta mean? You're using the Black-Scholes model. The delta puts the, runs analytics on the option, and a delta is one of the risk, the Greeks, that tells you your risk of the option. So a out of the money option will have a smaller delta, in the money option has a bigger delta, at the money has a 50 delta. And what this will mean is that a negative delta means that if you bought the option, it moves in the opposite direction of the stock. So put, right, if the stock goes up, a put price will go down. If the stock goes down, a put price will go up, right? A call is the other way. Call, if the stock goes up, the call goes up. If the stock goes down, the call goes down. The delta is saying that if everything else at this moment, if all the other Greeks remain the same, implied volatility, the days to expiration, everything else remains the same, what is your risk for the option for a $1 move in the stock? So keep in mind, everything else, all the other variables we remain the same. That means that this SPY put, if the stock goes up $1 from here, this put is expected to lose 12 cents. That's what the Black-Scholes model is telling us. If the stock goes down $1, then this put will go up by 12 cents. That's what the Black-Scholes model tells us. Okay. Any questions on that? If not, I'm moving on.
Yep, you can move on, bud.
Okay. Bid-ask spread. this is really telling us the liquidity of the option at the time of the trade. So the liquidity we could measure in different ways. One is the difference between the interest to buy, the price to buy, and the price to sell. So the narrower it is, the tighter it is, the more liquid the option is, because the cost for an immediate execution is cheaper. The wider that market is, the cost to get an immediate execution goes up. So if you look at all the markets and benchmark everyone to the midpoint, thinking that the midpoint is the fair market to market value, then the further you go away from the midpoint, the more it costs you to get an execution. So that's one way to measure liquidity. There are other ways, the size, right? So you want to know not just how wide the markets are, but how much you could actually buy and sell at each price. So if you could only do 10 options at each price, that's not as liquid if you could do 1,000 at each price. So the spread of the market and the size of the bids and quotes tell you how liquid the option is. Okay, so that's a liquidity measure. The trading edge here, what we put is, well, this is rounded. If we took the option and said how much away from the midpoint did it trade, that's how much edge, theoretical edge, that trade gave up from the midpoint to get executed. Okay, so here you could see most of them are very little. They're not paying a lot from the midpoint in either direction, buying or selling. It doesn't matter how far away from the midpoint are you. So the further away you are from the midpoint, the more that trade was willing to pay the market makers, the people providing liquidity, to get an execution. Okay, so that's the cost to get the immediate execution of that trade. I'm going to keep moving on until you have any more questions. I think we're going to have to do a part 3 here, Will.
Part 3 will be great, D.
Okay. Now, another way to analyze this option is, we know that the option prices are moving around, and they're moving around based on the stock price, where the distances of the strike price from the stock price. Obviously, that has an impact on the option price, but also the relative premium. So the premium is kind of like the time value in that option, or the amount over parity that you're paying for that option. And we measured that by using the implied volatility, right? So it's going to depend also the days to expiration. All this we measure by the relative implied volatility. So if we take a trade and we capture what was the implied volatility at the moment of the trade, for example, this is 14 volatility. We want to kind of then get a sense of, well, is this option premium high or low, right? And there are different ways to measure it. There's not one single benchmark. We talked about yesterday how we could look at historical implied volatilities for similar option, same days to expiration, same distance away from the stock price, and then we compare it and we give it an implied volatility percentile rank. So that's one way to measure it, the volatility versus itself from a historical perspective. Another way we could compare it is to the stock volatility, the actual underlying volatility in most recent history. So here we see that in the last 20 days, I think this is SPY. Let me just scroll back really quickly. Okay, this is SPY. So this particular option implied volatility is 14. In the last 20 days, the realized volatility of SPY is 14.1. So that's really pretty much close in line where this stock has been trading in the most recent history. In other words, if you do not expect implied volatility to start going up from what it has been doing in the recent 20 days, or you don't expect it to go down, then you think that the same volatility in the last 20 days, your best guess is going to persist in the next 20 days. It's kind of right in line, right? 14.1 of 14. So that looks like it's pretty fairly priced relative to the most recent history. Now, of course, if you think it's going to go up because there's some catalyst event, maybe you think there's going to be some news that is going to move this particular product, then it might be too cheap, right? The implied volatility might actually, the realized volatility might go up, pushing up the value of that option. So here we see relative to the 20-day, it's a 1% discount, not a lot, right? Really right in line. What about to the 1 year? Maybe it's 14 right now, that could be low. What if we reverted to a 1 year volatility? 1 year volatility in SPY is 17.1. So if we think then that by this expiration, whatever, let me see, May 26th, so really that's today. If you think that the next 1 day it's just going to move at the same volatility as the average volatility for the last year, 17.1, then you're getting an 18% discount in the implied vol. Okay, so that's, we looked at really 3 ways to look at the implied volatility: versus itself, historical, and versus its realized volatility in the stock in the short term 20-day and in the long term 1 year. And this just gives you a sense of where that premium is priced. Quantity, percentage, average volume. So here we're looking at block trades, and some of these block trades might look like they're significant. So here 546 options traded in one shot, $12,600 worth of premium in that option. Here's another one, 253 options traded for $4.40. That's $111,000 in one shot. I mean, these are not small numbers, 111,000, 305,000. So these are not something that maybe a person, a regular retail investor usually will trade at one time. These are probably, a little bit higher net worth individuals, maybe hedge funds, institutions. But we wanted to see, is that really unusual for this stock? And one way we could take a look at is the trade quantity. It's 546 options in one shot, unusual. Is 2,000 shares unusual? So what we could do, we need to kind of make it into a relative number, right? We need to compare it to a historical number to see if this is unusual. So what we do is we say, well, what is the average volume in this stock, right? What is the average volume in SPY in all the options? And then we'll just take this one quantity and divide that by the average to see the percentage and to see if that's very unusual. So here we kind of see these are not unusual, right? Not really. I'll give you an example. I'm going to use a filter. I'm going to come back to the filters, but I'll just use a filter to show you an example. Here's a filter quantity as a percentage of average daily volume. And let's do, I don't know, I'll do above 100 to see what comes out. So here's quantities above 100, right? So I'm going to show you what that looks like. Oops. So you can see here, PIRS, and this is a small price stock, but you could see 96 contracts traded in this and this, which might not ring the alarm bells, but I'm going to open this up really quickly. And on average, it trades 95 contracts in total. So that's if we added all the option volume in all the strikes and all the expirations, it's usually on average 95. So we see this one trade was 95. So that's a little bit so that's more than what you would regularly see in a single trade. And I don't know what happened, but there it's up 27% in pre-market. It was up 103% yesterday. So something might be going on in this biotech. But that's just giving you that this is a little bit unusual. GACK, this is a floor trade, multi-leg. So you could see 1,000 contracts each, each side of it. But I'm going to just open it up and show you that on average option volume, average daily option volume in the last 90 days was 633. So that's, remember, total. That's not in one specific option, but all the options chain, right? If we totaled it up on average 633, we see each leg 1,000. Okay, so that's your PIRS. Again, that showed up yesterday a couple times. Actually, PIRS was really popping up yesterday. So here, that's one way to filter out something even more unusual than just the quantity or because we're taking it and using it as a relative volume. We're saying, is it unusual relative to what it usually trades historically? Then we got number of days to expiration, and then any events coming up, which are important. We put here, and if you hover over, you could kind of read about like the upcoming events that will cover the expiration. So I'm going to have to end here. We're going to have to do a part 3. But
yeah, just so we know, we had a question about how you got to that screen, so maybe tomorrow we can start there.
Yeah, really quickly, it's under the screeners, option block trades.
All right, great.
Okay.
Awesome job, Deem, as always, bringing a new webinar every day to the Chameleon community live, real time. Thanks, buddy.
Thanks, everyone, for joining us. Stay safe out there. Have a good trading day. Hope to see you guys tomorrow.
Have a great day, Chameleons. Listen, there were a couple people asking about groups where people can talk to. We do have a Discord group. Email me at williammcbride@gmail.com if you want a link to that group in Discord started by the Chameleon community. Dima, great job. Chameleons, thanks for your participation in this great endeavor. Have a safe trading day, everyone.